There is a number hiding inside every penny stock trade. And if you have ever been tempted by those flashing red tickers trading for pennies a share, this number is going to ruin your day. 78% of active penny stock traders lose money. Not break even, not underperform the market, lose. Ask yourself a simple question. Would you sit down at a casino table where 78 out of every 100 players walk away poorer than when they arrived? Probably not. But that is exactly what millions of retail traders do every single week. Penny stocks are shares of small companies that trade for less than $5 each. Many trade for just pennies. They live on the fringes of the stock market, on what is called the over-the-counter market, far away from the polished floors of the New York Stock Exchange, and they lure people in with the same psychological hook that casinos have used for centuries, the dream that a tiny stake can turn into a fortune overnight. But the data tells a very different story. According to the Securities and Exchange Commission, 78% of penny stock traders lose money. The average loss is around 27%, but the median loss is closer to 37%. That means the typical penny stock trader does not just lose, they lose big. What exactly are penny stocks? A penny stock is any share trading below $5. Most trade for just pennies per share. They are not listed on major exchanges like the New York Stock Exchange. Instead, they trade on over-the-counter markets. That means lighter oversight, less transparency, and significantly higher risk. There are over 12,000 penny stocks currently trading on US markets. That is more than all NYSE and NASDAQ stocks combined. 12,000 opportunities, or 12,000 traps, depending on your perspective. A landmark study by the Securities and Exchange Commission found that 78% of penny stock traders lose money. Think about that. 78 out of every 100 people who try this walk away with less money than they started with. And it gets worse. The average loss was 27%, but the median loss was 37%. That means half of all penny stock traders lose more than 37% of their investment. The typical result is not a small setback, it is a significant financial wound. Now look at the scale. For every penny stock trader who makes money, roughly 3 others are losing. The math is brutal, and it is relentless. Every social media post showing a 500% gain has an invisible crowd of losers on the other side of that trade. Most penny stock growth stories follow the same pattern. The stock gets hype, the price pumps, retail traders pile in thinking they have found the next big thing, and then the whole thing collapses. The promised growth shatters, just like everything else in this market. So why do people keep doing it? It starts with a hand hovering over a buy button. Your screen shows a stock trading at 2 cents a share. Your brain does the math. If this goes to $2, I make 100 times my money. The slot machine effect kicks in. And that is exactly what this is, a slot machine. Stock tickers instead of fruit symbols, lever pulls instead of mouse clicks. The casino and the penny stock market are using the same psychological playbook. Your phone buzzes, another rocket emoji, another to the moon post. Another stranger on the internet telling you this penny stock is about to explode. Social media is the casino floor of the penny stock world, and the house always wins. You look at the green numbers on your screen and see nothing but potential gains, but you are conveniently ignoring the red losses hiding in plain sight. The lottery ticket comparison is not an exaggeration. The odds of winning a jackpot are 1 in 292 million. The odds of losing money on a penny stock are 78%. At least the casino tells you the odds. Now let me tell you the risks that the penny stock promoters do not want you to know about. Risk number 1, delisting. When a company can no longer meet the requirements to stay on a major exchange, it gets kicked down to the over-the-counter market. Once delisted, it becomes nearly impossible to sell your shares. They might be worth 0 overnight. Risk number 2, dilution. Penny stock companies are almost always running out of cash. So what do? They print more shares. They flood the market with new stock, which makes every existing share worth less. Your 5% stake can become 0.5% overnight. You did not lose money on the price. The company literally took value from you. Risk number 3, your stock certificate becomes worthless. No buyer, no market, no value. the company disappears, empty offices, abandoned projects. Many penny stock companies are shells that exist only to sell shares to retail traders. Risk number 4, liquidity, or rather, the complete lack of it. Try selling a penny stock in a panic. You will discover that the bid, the price someone is willing to pay you, is sometimes a fraction of the last traded price. The order book is almost empty on the buy side. You see 10 cents on the screen, you try to sell, you get 5 cents, sometimes nothing at all. You want to exit, the door will not open. Nobody is on the other side of your trade. Now let me show you how the pump and dump works. It is the oldest trick in the book, and penny stocks are its favorite playground. Step 1. Insiders quietly buy shares of a nearly worthless stock. Step 2. Hype begins. Social media posts, paid newsletters, fake analyst reports. Step 3. Retail traders see the price moving and pile in, thinking they have found the next big thing. Step 4. The insiders dump every share at the peak. The price collapses. The retail traders are left holding a bag of nearly worthless stock. It looks like a rocket launch from the outside, but it always ends the same way. The pump always ends in the dump, and 78% of the people who played this game lose money. So here is the honest truth. If someone is trying to sell you on penny stocks, they are not trying to help you. They are either trying to sell you something or they are trying to use you as the exit liquidity for their own trade. The data is clear. 78% of penny stock traders lose money. The median loss is 37%. There are over 12,000 penny stocks on US markets, most trading on lightly regulated OTC exchanges. The risks are real: delisting, dilution, pump and dump schemes, and a total lack of liquidity when you need it most. The stock market is one of the greatest wealth-building machines in human history, but like any machine, you have to use it the right way. Penny stocks are not the shortcut, they are the trap. Look for real data, demand transparency, and never play a game where the odds are this badly stacked against you. Thank you for watching. If this was valuable, subscribe to Trade Tape Insights. I will see you in the next one.